Hello and welcome to a special two-part episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I have Fred Destin. Fred, for those that need an introduction, is the founder of Stride VC, a seed fund operating out of London and currently investing out of its second fund. Their tagline is Dissenters Welcome. Prior to Stride, Fred was a general partner at Accel and Accomplice. He was a lead investor on 7 companies that have exited for over $1 billion in value, including Deliveroo, Zoopla, PillPack, now Amazon Health, and many others. In these episodes, we talk about how founders have a level of discontent with VCs and how surprising that has been. Is operator as a VC a magic label? How many VCs have empathy for the founder journey? And why minimalist boards and how VCs can move the needle for the founders they work with is so important. Navigating the need to be seen as a VC, venture as an artisanal occupation, the fact that venture is not complicated, but that you do need to be adaptable, and how you make decisions in a state of uncertainty. We talked about, as a VC, you are living in a world of both skill and luck, how returns come from the pick and the entry price. We talk about the Cambrian explosion in venture and where we are now, and how you can be a generalist, but you can't be generic. We end up in the second episode talking about VCs as human beings, how you can embrace the beginner's mindset, and how you should look beyond the information that's being presented to you, and how to avoid the trap of lazy thinking. Let's get into it. This is Nothing Ventured with me, Aarish Shah, the podcast where I talk to the people behind the stories that make the venture capital ecosystem go round. I've been working with startups from pre-seed to Series C for the last decade, and companies that I've worked with have gone on to realize value and exit, or raise funds in excess of $500 million. I really hope you enjoy the episode, and if you have a guest that you'd love to see me have on, or you have a comment on any of the episodes that I've recorded so far, do reach out to me on LinkedIn or Twitter. I'd love to hear from you. Let's get straight into it. Fred, really wonderful to have you in the studio with me. Thank you so much for joining.
My pleasure.
This is going to be slightly different to the majority of pods that we do. And I think it's probably going to expand over a couple of episodes because I think we're going to get quite deep into maybe some of the more meta details of what it means to be in venture. So you've been working in the field for 25 years now. That's a lot of knowledge to distill in a relatively quick chat. So let's explore some of the themes on life, venture, investing in exceptional businesses, and more importantly, exceptional founders. So, we talked around a number of themes, and one of those that came through very much and seems kind of core to how you think about venture is how VCs can show up for founders. So how do you think about that?
I mean, the first statement to make is that I am continuously and consistently surprised that when founders have a chance to be honest, so in a private setting, in a founder-centric group, the level of discontent with their relationship with their VCs is just unbelievable. And it's so systematic. Now, this is not everybody. There are a bunch of founders who say they enjoy a great relationship with their investors and have very productive boards, but maybe 90% of the time, the answer is the exact opposite. So the kind of comments that come up would be, I do not trust my board with any topic that I consider to be truly sensitive. Or I'm wary of bringing certain topics to the board because I know they will either leverage it against me, react poorly, or I will not be able to control where the conversation goes. So one example, recently we were talking about exits, and I was sitting next to an exited founder who had a pretty massive outcome. And we were talking about when to start exit planning. Now, exit planning is one of these strategic topics that you ideally start thinking about 3-4 years before you actually get exited.
Yeah.
And I was naively sort of saying, well, if you made it a board topic and this was a regular topic of conversation, you can understand the chess game that's being played in your market, who the likely acquirers are, how to build diplomatic lines of communication to that population group. And he laughed understandably and said, "You don't understand. The moment I mention the word exit at the board, I'm going to have half of my board thinks I want to sell too early, and the other half of my board thinks we should sell right now. And there's no way that I would trust the board with that."
Just quickly on that point, then, is that a function of an experienced board, or is that a function of, I guess, the nature of venture to some extent is, always looking for obviously the large outcome. What is it that you think causes that moment of kind of existential dread amongst the board, right?
Well, so what you're faced with here is a poor conversation. So in other words, the quality of the conversation is terrible. It seems that everybody's coming with their desired outcome, and you're not really talking about the topic. I think more generally, so founders, I don't think, trust their boards in terms of bringing up complex topics. If you don't have trust in a relationship, you really don't have much of anything at all. And it's quite foundational to the relationship to be able to speak in trust and truth. And I think what I observe, the kind of behaviors I observe are advice given freely, which half the time is not truly relevant to the business. So it may be good advice in theory. It's not like people are saying stupid shit, but it's not really applicable to where the company's at, given its people,
that
its
mentorship.
resources.
Yeah.
So it's nice in theory, but not applicable. So you will see founder roll their eyes at that. Very often you have advice that's just ungrounded. So literally somebody has been to another board and heard about a new technology and comes and asks what we're doing about that thing. So some of it is just irrelevant. Some of it is presented too strongly. It's very difficult to present generalized advice. And so people come with their own baggage and their own history and just present one version of the truth.
This is what we did. This is what you should do.
Correct.
Yeah.
By the way, which is one place where people always say, oh, operators make for better VCs. I would temper that and say operators may make for better VCs, but it is not a given. And one of the things you see with operators is they come with a lot of crystallized knowledge from where they used to work, and they try and apply it in a startup, and they can't, kind of reframe how they think about stuff.
And there's 2 points there, right? So one is operator as VC. There's also operator as board member, right? So I find that when I think about, and we'll talk about the craft of investing, but when I think about venture, I'm hindered by the fact as an operating kind of CFO, I get deep into the numbers, right? And as a VC, you got to look beyond today, right, into the future. So that potentially as an investor might hold me back. On the board, it's a different matter because I have experience. I've understood kind of how boards operate, et cetera, right? And bringing the experience of an operator is helpful potentially to the founder, because there may be things that I've seen either at a strategic or even at an operational level that change things. So is that dichotomy? Is it that being a VC is actually multiple roles? It's not just one, right?
Yeah, correct. So look, first of all, the state of the nation is that the VC founder relationship is broken.
Yeah.
Then you can start to unpack what you actually expect from a board member. And what I would also say is people live in tropes. And the tropes are, we live in a sort of mimetic world where simplified ideas seem to be the truth. So one of the tropes is every VC should be an operator, right? That's a trope. I would argue founders are uniquely placed to become great board members because they built from 0 to 1. They started things from scratch. They had to make decisions under conditions of uncertainty. Operators, not so obvious, for example, because if you're a middle manager at a large US tech company, in what way does that make you uniquely positioned to be a board member at a high growth startup and building companies from scratch? You've never done it. You may be given a set of instructions by HQ, which you then deployed across a team that you manage. So this, people use these labels as if they were magical. You will magically be better at the job of being a board member if you're an operator. There's also, it's a question of, first of all, what are the roles, right? So if we break it down, a good board, first of all, if you go to a board as a VC and you meet and you're working with a founder, What if you reframe the whole thing and said, I will be your partner in building this company?
Mm.
Now, there are limits to the partnership. If the company underperforms and I can't back you, the partnership may end. But I will go in as your partner and let's discuss what a partnership looks like. What do you need? What do I need? How do we operate? How do we interact? What are my blind spots? What are your blind spots, right? I bet you nobody does that, which is first setting the stage for the relationship and understanding each other. You just go into your first board and you start talking about the business and kind of hoping for the best. If you put 5 people in that position, what do you think is going to happen, right? It's kind of difficult to create alignment. Secondly, so what's the role of the board member? Well, you're an accountability partner, right? There is a portion of governance, etc., which is like, hey, every 2 months or whatever, we're going to sit down and there is accountability. It's great to have an accountability partner, right? So as long as the accountability partner is not an asshole, it's a great place to be because you have somebody holding you accountable to what you said you would do. It's really useful. A lot of experienced founders actually say, I love having a board because it holds me accountable. Okay, cool. Now beyond that, next thing is, do you have my back? Are you there in the inevitably difficult conditions that are going to show up? And one of the ways I think about it is, did the founder leave the room more energized than they came in? If you can be in a place where even if people are facing hard difficulties, but because you've unpacked the situation or you talked about how to solve it or you just pumped them up to go like, all right, let's get back in there, did they leave with more energy than they came in? The vast majority, if almost all the founders I speak to, it's the opposite. It's not all of them, I don't want to oversimplify, but a large majority, it's the opposite. They find the board to be a chore. They don't look forward to it.
Drains energy.
They kind of, they're tense going in, and then they kind of survive it, right? So it's no surprise that a bunch of founders would just want benign boards. Let me take people that are easy to deal with and kind of pushovers, and I'll just have my own little strategic group on the outside of the board because the board is not the forum.
I'm doing it because it needs to be done, not because I think it adds value. But and again, because in what you've just described, is very much the founder as the champion, and of course, in 90% of the cases, that probably is correct. But is there also an element of founders not understanding what a great board looks like?
Well, so before we go there, let's just finish off with the roles because. So you have this accountability partner. I'm going to, do you have my back in tough situations, which goes back to empathy. How many people have empathy for the founder journey? How quickly do you lose it? And then it's like, what else can you do as a board member? Because it's also not everybody needs to be the same. So I personally like complex strategic decisions. So my jam is I want to help us collectively think better about complex strategic problems. Somebody might be a transaction hound, right? And somebody who's very experienced in transactions. So they may not be product-centric or design-centric or engineering-centric, but you know what? They might know a lot about fundraising, M&A, et cetera, et cetera. And so they might bring that lens to the table and actually have value purely as that. So having a very astute investor who knows their place in the world, they know where to interact and where not to interact, who's a first principle thinker, can be extremely useful because this is somebody who's going to think risk return, allocation of capital, return on capital invested. They're going to come with a certain lens on the world, which is like, how do we use the money we were given intelligently? It's really useful. While somebody else might come with a very product-centric or design-centric sentiment and say, hey, why don't we bring the voice of the customer more into the room? And then ideally over time, you can cover all these things because, you're able to interact intelligently around the whole host of topics, which, makes you this sort of 360 board member that can kind of look at the whole territory and be helpful. Now, but where do we live? We live in a place where like VCs are shit and the only thing that matters is their intros.
And the money. That's it.
But I mean, okay, that's also a lie because VCs are going to be on your board for 7 years. And when you come to key decisions, you're going to have to make some of them with your financing partners, right? Raising new capital, selling the company, going bust, acquiring. I mean, it's got a pretty big event.
Strategic hires, senior hires, right? All of this sort of stuff, yeah.
So this whole idea of like, yeah, you just want interest. It's like, it doesn't work that way. You're in a contract with a set of financing partners anyway. They may be a minority, but they have certain rights. So we're sort of trying to evacuate the fact that there's no relationship at the core. And I'm like, can we like build a relationship and then everything else will become easier?
I mean, like exactly as you say, it's often a case of like four board members, whatever the number is, rock up to a room. They have not necessarily had the conversation about, well, okay, this is where I can add more value. This is where my skill set lies, etc. And everyone is also, I guess, to some extent trying to, force their mark upon either the founder or the company. There is a lot of ego involved often in these sort of environments, right? But actually, you almost need, a pre-board offsite where you just explore where each of you can add value and how you're going to show up for the founder and the business. Ultimately, it's not just the founder; it is the business, and where you can support them through. Hopefully, not many, but clearly there will be difficulties that arise, right? And in today's environment, I would say having an incredibly strong and focused and aware board is more important than ever, right? Because it's hard to navigate the current market.
For sure. I like to think of minimalist boards, which is, a lot of venture capitalists will actually arguably spend too much time with their companies, but not on things that move the needle, right? So for me, it's like, the way I think about it is, what are two things that I can do for this business at any point in time that will be somehow some form of contribution? So recently, I was with Callum at Cashmere Intelligence, and we spent five hours on a Monday afternoon just having a very flowing conversation about strategy. And we filled the whiteboard from 5 years out to 3 years out to a year out, and it was just exploration. Because I thought, as a company that's kind of refining its model, I thought it was a good time to go just very creative and very broad. Okay, so that was my contribution for this particular quarter to moving the needle. And I think Callum was thankful, and I also just enjoyed the whole process, frankly. But we're like, okay, so we have got a clear idea of our positioning. We've made some useful distinctions. We understand we're a deep learning company with a federated learning environment platform, in complex control processes in industrial environment. And we came out with this language and this positioning. Like, okay, well, that was a contribution, right? Instead, you find that people go at the board meeting feeling I have to be adding value, which is, by the way, that's their need. It is not what's required in the room necessarily, or that they want to be heard, or that they want to show they're smart, or that they want to show they have network. So they come with like something inside of them that they want to bring to the table.
You should do this. Oh, I came across this, and actually you should consider doing
right?
X, Y, Z. Yeah.
So I was recently at Buena in Berlin, and it is such a well-run company that over the course of 3 hours, I expressed support 2 or 3 times, basically saying, that's amazing, that's incredible. And by the end of the board, I kind of had nothing to say. Now, we've done a lot of strategy work with them in the past, etc. And I just sat there, and I'm like, and I felt the need in me to say something. And I'm like, okay, no. And I just said, you know what? It's the first board in 10 years where I have nothing to say. And what a relief. Because there was nothing to say. There was nothing required of me. But so as a board member, you really have to watch what you bring into the zone. So very often people want to be recognized. There is a need to be seen. We're human beings. We all have the need to be seen. And so you want to be seen to be smart, or you want to be seen to be adding value, or you want to fix something for the founder, which they should really fix themselves. And so all that stuff you bring into the zone, and it just pollutes the environment, especially if you're patronizing and, if you're committing one of the cardinal sins of just basically being an asshole, being patronizing, talking at people, providing ungrounded advice. I mean, if you're committing one of the cardinal sins of being a shitty board member, that's easy. But even then, you just want to watch, like, this thing is not about you. It is about the company making the right decisions at a specific point in time. And just understanding what game is being played here rather than being stuck in your own mind is important.
So that's interesting, because often it is not the founder that is choosing who that board member is, right? Like that board member is representing the fund or or financier that has come into the business. And so the founder doesn't necessarily have control over that. So how can a founder better equip themselves as well as the other board members and the board members around the table? How can they set that narrative? What is the best way to approach that? Because those egos are going to show up. Like they're
Yeah, it's a good question. So let's talk about selection first. So the very big brands in market will have you believe that brand is everything, right? Because that serves their game. It's how you perpetuate success. And by the way, the big brands are there for a reason. So if you look at an index, etc., they're incredibly well-managed firms. But leave that aside for a second. So they're selling you on the brand.
Yep.
And then some of them will do a bait and switch. So I'll throw a lead partner in there who's a general partner. And then I'll actually say this person should be on the board, which may or may not be the right person, but they will do that. They will do that thing. Board member is one of these people that you cannot fire. So this is a classic non-reversible decision. So you want to think about it carefully. They will make your life hell for years if they're assholes. I mean, the compound effect of being on a bad board with annoying board members on the morale of founders is not to be underestimated. So the first step is like, well, can I actually choose? And I always say to my founders, it's like, do you have the perception that this person deeply understands your business? Do they give a shit about it? Do they give a shit about your success? Are you able to have deep conversations about what you're building? Is the quality of the challenge you're getting back high quality? It's like, how sophisticated are they at understanding what I'm doing? And for me, it's like, let's start with that. If they're smart, articulate, and deeply understand your company, which I know doesn't necessarily show up every day, but I mean, okay, now we're in a good spot because at least the quality of the conversation we can have is pretty high. Now, if you're set up with the wrong board and you have egos who are superficial and like to come and hear themselves talk, you're kind of fucked. And then you should probably run your board as the most benign environment that you can. And actually
checkbox, yeah, sort of just.
We do that sometimes, by the way. We have the board. It's like once a quarter. It's like it's the weather report, right? Did it rain? Did it shine last quarter? And we go through that. It's very well organized.
But a lot of founders equally think that is what the board is there for, or inexperienced founders, I should say, right?
I mean, see, what's interesting is how much we talk about the fucking board. And how much of an oversized topic that is versus what it should really do. Yeah. I think for me, in early stage startups, it's like, okay, the accountability piece is important, but let's not overstate it. So it's basically, we design our boards. We basically like try to get rid of board packs systematically. It slides. So we encourage founders to write a memo. It's a lot easier. Google Docs. They can write, ideally it's the same memo internally as for the board exactly. So whatever they're going to share with the company and where the strategy is at is what they can share with us. So it's the same tone, it's the same content, it's the same shebang. The preparation is limited, and then we try and do KPI sheets. And ideally, these are, there's some form of analytics. And again, they're the same internally as for the board, and they're the same over time. When Alex Chesterman and I designed the KPIs for Zoopla, these stayed for 6 years. I don't think we changed anything because we really spent the time to actually do them properly.
What is the right North Star to be chasing? What are the right
metrics?
We
ran this company on two Excels. One was everything that had to do with site and metrics and acquisition, etc. And the other one was financials. We ran this company on two Excels. That's all we ever had to look at. And we knew the definition of the terms. There was no discussion required. I'm amazed the number of boards where we sit down and we're like, what's the definition of bookings again? And you're like, shit, we've gone over this 12 times, What's committed ARR versus ARR, and why is the discrepancy that big? And you sort of keep cycling through the same crap. So you take the accountability piece, you keep it because it's important, and the founder shows up and he says, green lights, orange lights, red lights, whatever format you want, because that's important. And then you stop there and you go, all right, I have two topics I want to discuss. One is I need to think about my organization design because we opened in the UK, want to launch in the US. my VPs are all over the shop and I don't know how to fucking build this thing and I'm struggling. Okay, cool. So let's do that. And go to market. I want to go mid-market and I want to talk to you about whether that's right or whether we should stick to large enterprise. I'm taking an example. Okay, these are two interesting topics. You then come with a little bit of research and frameworks, etc. So you're actually having a conversation that's rich. You let people know ahead of time so they can think about it. And then we're having a good conversation with the people around the table.
Yeah, the worst boards are the boards that show up cold, like just no context, haven't kind of done the...
I mean, you can't have a deep strategic discussion if, you get the slides the night before and everybody's like, so what's the topic? It's not going to work, right? So you let people know a month or 2 months ahead of time. It's like, we're going to talk about our mid-market strategy. Here's some articles we found, etc., just to help people refresh, first round review, like best content in the world. So here's a framework to think about this shit. And we'll send you a short paper. Again, like these strategic papers a la Amazon, for me, that's the game changer because, I mean, I don't do anything without writing it down.
It helps the process of thinking.
Yeah,
right?
writing and summarizing is the way I crystallize the things that matter. So do that, and you're doing that for yourself. You're not doing it for the board, right?
And so going back now to the founder VC relationship, right? Because the board is just a part of that, right? And you and I talked about just going for a walk with a founder. Like a lot of VCs that I've worked with are very good at that out of board interaction with the founder, right? They're there, they'll WhatsApp, but not in the sense of like hammering, what are you doing, what's going on, but actually just checking in and trying to understand where things are at, right? But equally, I think a lot of founders would be hesitant to really share the intimate details of the pain they may be going through, the anxiety, the suffering, whatever it is, right? Like we've all been, this year has been a disastrous year for many, many businesses, right? Like, I mean, my business is probably 50% down on where it was last year and it's now coming back up again, whatever. But it's very difficult for founders to potentially talk about that to essentially their investors, right? Because any signal of weakness may be perceived as, blood in the water. There's something that needs to be done here, right? So how can VCs, I guess, you talked about empathy. How can they show up with that empathy and walk their founders through those sort of problems?
Yeah. So if you're talking about founders being able to share the founder journey at a personal level, I think that's a subtle question. If you're able to come to the board table and say the company's struggling in this department, that department, like Will Shu at Deliveroo used to come in shorts after his workouts and he'd sit down and go like, everything's fucked. And then he'd put the list of things that were like, or whatever, driver orders, too many manual. And he would just come out with the shit. And it was incredibly relaxing, right? Because everybody's like, well, okay.
It's on the table.
Well, now we're working, right?
Yeah.
Now we're talking about the real things. And he would just come out with it like, okay, here's the stuff that's broken. That I found extremely refreshing. And if you can show up that way as a founder, that's actually a sign of strength and authority. And then, nobody disrespected Will ever around that kind of stuff. Now, again, with many boards in the real world, you want to tread carefully because people freak out in the face of uncertainty, right? Now, if you're talking about the personal journey, I'm struggling, I might be heading towards burnout, etc.
Yeah.
You may have a board that invites that in and knows how to deal. You may not. And I think in the vast majority of cases, you probably won't. So that is probably a discussion you can have either one-on-one in the sanctity of a really safe relationship with one of your investors.
Yeah.
But ideally, you go talk to a coach about it. And, I don't know that I would trust too many boards to deal with that particularly well. And part of it is not evilness. It's that the role of the board is to decide who runs the company. And so if somebody's really struggling, at some point you're like, well, okay, but there's something we need to do. Now, again, if the quality of your relationship is great, You might sit down with the founder and say, how bad is it? And, if they can't function because they're deep in anxiety, you've got a problem. But then the founder might raise their hand and go like, I'm fucking struggling. And then let's work together on figuring that out. It may be temporary, maybe something that can be unlocked.
Maybe situational or something that's happened at home or whatever, right? Yeah.
So if you have, again, that quality of trust, you can. I think otherwise I'm going to talk to maybe my co-founder about this, my coach. And then I would say on that point, it is the responsibility of the founder in terms of their responsibility to the company to figure out whether they can hold the line, right? I have zero issues with people coming to me about that. And I think actually very often we'll have that conversation, which is, how bad is it? Can you still function? What needs to be done? How do we support you? But, at some point, my responsibility primarily is to the company, and that will come into play. But I'll be transparent about it, which is, I've got your back. I'm here for you. Let's be patient.
I'm not going to come behind and say, right, we got a problem. We need to replace.
So you will be the first. Let's talk about this together, because what I'll do probably is bring a little bit of perspective to what's going on. It may be that, hey, you're not the first person to go through this. We're just going to have to, kind of manage your intensity a little bit and maybe ship you on holiday and maybe hire someone to support you or something. Or it may be that you have something more profound. You've hit a zone of trauma, or somebody's full on in anxiety, which happens, or they're
not the right. They aren't integrity.
They're melting.
Exactly.
Or they've reached the ceiling of what they're able to do at that point.
They can go from 0 to 1, but maybe not 1 to many or whatever, right?
So all of these things are possible. I would also say, this is where founder identity being meshed so tightly with the company can be a real danger, because, people die trying to build startups because they run themselves too hard.
I write about it a lot. Like, I always say, you are not your business, right? I think there is something both intrinsically, natural about feeling that kind of close symbiosis with your business, but there is also something incredibly unhealthy, because if you tie your self-worth and your value to that business, we all know 90%, whatever the right metric is, but a lot of startups fail. If you are so enmeshed in your own personality with that business, then any failure is going to impact you quite heavily, right?
Yeah, failure and success.
Yeah.
So it's interesting, because people have been building so founders that I know build their businesses for many years, sell successfully, and then suddenly turn around and go, wait, who am I?
Yeah,
right?
Yeah. What's my purpose again? Yeah.
When we did the IPO of Zoopla, so I'm behind Alex, who's like, hits the buzzer, and then it's 10, 9, 8, 7, 1, and then stock starts trading. You're at the LSE on top of the stairs. It's a bit disincarnated, but whatever. And then we go to the traditional room next door. We sign the registries. We have a glass of champagne. And literally everybody started looking at each other going,
what now?
All right, let's get back to work. And so everybody walked back to their respective offices, and that was it. So it was like 15 minutes, right? And so I think as a founder, as you fully invest your identity into your company, and then suddenly you sell it, and then you kind of go, what the fuck? It's an interesting moment of interrogation, the kind of, who am I? Most people go right back in.
They either go again, or
who stops to think about actually what the learning is from that is an interesting question.
It's almost like, is it events, or is it the journey? Like, which is the bit that actually is, what are you chasing? Are you chasing the journey, or are you chasing the outcome?
Well, most of us live 4 years into the future. When this, then that.
Yeah.
And you can live your entire life like that until you die. Actually, never really being in the moment.
You never get it. Yeah.
Well, because there is no end game.
Yeah. We're going to switch tack a little bit, right? Because I think, the board dynamics and the composition and all of that is super interesting. But I also wanted to talk to you about, you talk about the craft of venture, right? And venture as an artisanal occupation. So what is it that you mean by that? And what are your thoughts on where venture is going well, and where it's equally not? I mean, have we lost sight of what venture is, I think, to some extent, right? The last 6-10 years seem to have been a lot of aberrations and, it feels like we're returning or, getting back to almost what venture, I guess, started off as in the 60s, right, in the US and so on. And I guess, those are two separate topics almost. So how does one build the craft of venture, but then also what should venture actually be?
Yeah, these are two big and somewhat separate topics. So when I say I think of venture as a craft, it is because when you look at the breadth of roles that we have to embody across the life cycle of an investment, A, there's a lot in it, and B, there's a lot of those skills that you can acquire and refine. So if we go back to the board member to link the two topics for a second. So the craft of a board member would be, how do I ask the right questions? What does a high quality question look like? How do I establish trust in difficult conditions of crisis? What does true active listening look like? Am I able to detect the emotional state of the people I'm talking to, which is very important? A lot of the cues are nonverbal. Do I have the strategic tools to think about what a company needs to do? So what are you using 7 powers? I mean, there's a whole host of frameworks. So part of the development of your craft would be to learn a few of these strategic frameworks and actually be able to apply them. OGSM, Objective Goal Standards and Measures, is the one I use, which I turn into the 531. I mean, once I mastered the methodology, I can deploy it over and over and over again because it's very generic. So you can break down between sourcing, investing, and decision-making, diligence, transaction execution, being a great board member, etc., and then running a firm. There's a whole set of tasks there, and the reason why I think of them as a craft is because the ingredients are always the same, but the answers are always different. So it's not like you're not running some kind of recipe book, you're not running code, you're going to deal with the same type of issues, but different humans, different market timing, different availability of capital. So it's like venture is not theoretically complicated, but you have to be highly, highly adaptable. So the analog to working wood would be when you work a piece of wood, you get to understand the knots that you're working with and the way the wood has grown. So here it's somewhat similar. It's good. There's an aspect that's quite organic. So on the one hand, you can learn methods, and I think the more you learn, the more you treat the craft with respect, the better you're going to be. Let me pause on that for a minute. Most VCs that I have seen love the lifestyle, love the features of the job. Oh, it's interesting, it's varied, I get to travel, people pitch me, it's very intellectually stimulating. And they have some story, which I respect, which is my story as well, around I love to help founders build companies. But then they're kind of stuck there a little bit, which is they have a relatively high level view of markets. They don't go super deep into understanding how the companies operate. They don't go particularly deep in their relationship with the founders because sometimes it's uncomfortable. For example, when are you comfortable firing a friend? Because you can get quite friendly with founders and you may still need to remove them from their job. Hopefully never, but it happens.
It happens. Yeah.
So you're in a place of discomfort on the relationship side. So anyway, they stay at a relatively high level. And that's how you get the cliche of the VC who, lands into the board, drops a bunch of irrelevant advice and leaves. Because they didn't treat the whole thing as a craft. So the craft, for example, in terms of decision making is, do you understand that you're making decisions in conditions of uncertainty, right? So you're living in a world of probabilities and outcomes, and you're living in a world of skill and luck, right? When you live in a world of skill and luck, what you're not trying to predict success, because you can't predict success. What you're doing is you're identifying whether a certain risk-return trade-off belongs in your portfolio, right? So again, people have a superficial knowledge of the power law, and they can talk about the power law, but it's like, okay, but do you understand the nature of the risk you're taking, and how sophisticated can you be about that? And so that's one example, and we can sort of deep dive into decision-making as one of the aspects, but that's part of the craft, right? Part of the craft would be, how do I run effective meetings with founders without any form of leading questions? And how do I place them in areas of that are a bit difficult or a bit uncomfortable, but without feeling like I'm pounding them with aggression, right? Which is how a lot of VC meetings go. Cool. So that's a craft, you know. How do I? Most VCs go into meetings and ask the person in front of them for their metrics, which you can read on a fucking spreadsheet, and that's how they spend most of their meetings. It's like, okay, what is the thing that you're trying to eke out of a person in front of you to determine whether he's an exceptional founder? So we also want to back exceptional founders. What do they actually look like, right? So that's part of the craft. You know, what is the psychological makeup of somebody who's likely to be an exceptional founder? Because all founders are friendly, sell really well, are connected, are pretty smart. You know, they tick a lot of boxes. It's like, okay, well, so how do you uncover the exceptional?
There's two things that come out of that, right? So the first point, and it's great that you said it. Like, I think, you know, working in a world of both skill and luck, right? Like, I think far too many people, both founders and investors, underestimate the level of or the role that luck plays, right? In outcomes, right? And that may be due to market timing. It may be due to, you know, just, you know, the right email came through at the right time or whatever it is, right? But clearly there also needs to be some skill, because otherwise, you know, you wouldn't have high performing firms. But the second part that I think is super interesting, right? So if I think about the way most people think about the way venture works, they look at it through the lens of it's an investment game. But actually, from everything you've just said, the investment game is not a small part of it, but actually the you know, the deploying the capital is just the start. It's everything that follows that is actually the craft of venture as well. So it's not just how do you pick, but it's also then how do you support.
Yeah, it's always a it's an interesting question. The how much is in the pick and how much is in the follow-on. I think personally, so the vast majority of your returns come from the pick and your entry price, right? For obvious reasons. So in the pick is also what the transaction looks like. I think that's where the vast majority of returns comes from. If you do systematically good and disciplined work across a portfolio of companies, you can probably shift the risk on that portfolio by a little bit. So you're kind of bending the curve a little bit on your portfolio as a whole. It's somewhat difficult to determine whether if you did nothing at all or if you did great work, what the difference is. On occasion, you're going to have a massive amount of difference. Rarely. And if you're good at your stuff. So when I went out to recruit Scott Knoll, the CEO at Integral Ad Science, because our original founder got cancer. The person we groomed to become CEO felt it was too risky and left last minute. Our head of sales turned out to have a drinking problem. It was like a meltdown. And you know, I went out and interviewed 14 people, and I flew back and forth to New York a whole bunch of times. And then the first person I met, which was Scott, like couldn't quite get there on first meeting, and then kept interviewing all these other high-powered New York executives. And I remember going back to Scott and going, there's something about this guy, because he's very understated. There's something about this guy that I think will serve us well. And then, quote unquote, having to sell it to my co-investors because he didn't fit the classic super charismatic thing. And, you know, that was a $4.5 billion company. So had I not been there, like how much of an impact did I personally have on the outcome? I think there's something to be said for that.
So did it become a $4.5 billion?
It became a $4.5 billion company from a near wreck.
Yeah.
Because when this thing happened, literally our entire team was in meltdown, and we took the 4 VPs. They were all in their 20s, and we said, "You're gonna run this company," because we lost all of senior management like at once. It was insane. So it was like getting them to rally together. And I remember going to see them in New York, and we had this like crisis meeting. And we're like, all right, guys, they're all guys, unfortunately, but it's you. There is nobody else. You got to go run the show. And I'm like, I'll go find a CEO. So, you know, this whole process, you kind of go like, well, we did do something meaningful for the company in that moment. So on occasion, you'll do it. And then because it's a parallel game, the question is, Well, how valuable was that? You know, with PillPack, we had a few decisions. So David Frankel from Founder Collective and myself really pushed TJ and Elliot to go free away from a paid service, which I think was transformational to the business. And then there was a second one where we decided to build the pharmacy operating system. So PillPack was a consumer-facing pharmacy business, and then we decided to build the industrial brick of the pharmacy operating system. That piece of software, which took us about $25 million to build, ended up, according to Amazon, being half of the billion that they paid was for that.
Yeah.
So that came out of discussions with Elliot around, hey, what if we could go raise enough money to fully liberate you from any legacy requirements on the pharmacy backend side? And that's another moment when you say, well, that's an inflection point in the life of the company because that strategic decision can make a difference. So on occasion, you'll pull one of those, and most of the time you don't do anything that meaningful, and you can kind of question whether it was even worth all the effort and love you put in, right? But the thing is, you don't know ahead of time.
And one of those was born out of need, right? One, you had a meltdown, as you say, in the team, and the other one was a strategic bet. Essentially, it wasn't you didn't, like, Amazon wasn't waiting for you to build this, as an example, but once it was built, Amazon was there.
We paid a premium for that, for sure.
Yeah, exactly.
But so you're always looking back, and then you're linking the dots, and you're building your narratives. But the point about that is, well, if you do consistently good work, occasionally something will be transformational to your portfolio, and you just don't know what that is. Which is why, you get into that issue of like, well, how much time do I want to spend with my founders? Do they want me to?
Yeah.
Another question. But, where do I spend my time? Which is why a lot of VCs get lazy because nothing feels like it has immediate impact.
Yeah,
right?
it's a 10-year game, 15-year game.
You're throwing water in the ocean. It's kind of what it feels like.
Yeah. I mean, I think it's one of these things that I think a lot of founders don't necessarily appreciate either, right? Because in front of them, they can see the business, they can see where they're going from, and they assume that from a VC perspective, you put in the money and you walk away, and when the outcome happens, it happens, whatever, right? But from a VC perspective, you'll have whatever, 12, 20 companies in the portfolio. It may take 10 years to see even one of those return something, right? And it may not even be the sort of size of return that you want, right? So it's a long game. It's a really uncertain game, right? Like, so as a VC, and again, I guess this comes back to the craft of VC, you have to you talked about operating in uncertainty. I mean, VC is perpetual uncertainty to some extent, right? I mean, there is a question in my mind always around, you talked about whether the big firms, whether it's a brand that creates a self-fulfilling prophecy. I always wonder, right, if Andreessen Horowitz backs X company and X company is successful, would X company have been successful had Andreessen not backed it, right? And is it the momentum that Andreessen brings that has essentially allowed it to grow and scale and potentially exit? And I think there is that sort of constant question as to, is it the tail wagging the dog or is it the other way around, right? Like, where does the value, how does the value accrue? And like, very clearly, like, if a business is not, if a business doesn't have the fundamentals, then it'll never break through, right? But occasionally it needs that additional push that comes from a really great brand.
Yeah, I don't think there's an answer to that.
Yeah.
Look, I think great brands in venture are at the top mostly for a reason, which is they tend to operate incredibly well. They are at risk of arrogance. And so how well they manage their own arrogance is a question, because otherwise that's maybe the beginning of their own demise. And
maybe that's how much time they spend on Twitter versus anything else. I don't know.
Maybe. Now, I think if we're humble for a minute, great companies will perform no matter what.
Yeah.
And this is, again, the story you're being told is the VCs made the business. I don't buy that. And you just have so much variety of companies with varieties of capital sources that have done great that I think you just gotta, all right, let's just go in the back seat for a minute and get back in place where we belong, that these were founder built. I think the reverse, though, is painful boards may damage businesses. There's an old saying in Silicon Valley, a good board does not a good company make. but a bad one will destroy you every time. Bad boards are painful, and they're worth fighting hard to avoid. So
it feels like you have like some real trauma over kind of boards.
I mean, I'll give you one anecdote. First of all, ask any experienced founder. Well, get 100 founders in the room and see how many horror stories come up. Because this is not a perception on my part. This is also, I have run in the past these informal surveys, and the horror stories are everywhere. But then, worse than that, it's not so much the horror stories, it's the mediocrity of it. This kind of soul-sapping mediocrity, grayness of the whole shebang. I'll give you one example. There was one company, we used to have 7-hour-long board meetings.
Wow.
And in one of them, we just hired a new head of sales. And one of the investors insisted, the guy literally just come on board, and he was with one of our large clients somewhere in the building. And because the company had missed its numbers, he insisted that they bring the guy in. So they interrupted his meeting with one of the marquee clients, brought him in. And when the guy came in, my co-investor said, well, you're not allowed to sit down, you're going to stand.
Oh, wow.
So he made him stand next to the deck and started asking questions such as, do you think these numbers are okay?
Yeah,
right?
Yeah, like as a CFO, when someone says, is that number correct? I'm like, define correct. Like,
so it was a dressing down of a newly appointed exec as a show of power, assertion of power. And, I remember the CEO and I had to run after this new head of sales to buy him a beer and convince him not to leave. Like, don't worry, he's not that bad. It's just for show. You'll see. But, that's the kind of shit. I have 30 stories like that.
Yeah.
And for me, they don't bother me that much, but my founder empathy, my founder injustice flag goes up, and I'm like, the fuck, so I will get somewhat agitated when I see that. So.
Yeah, I think anyone with with any sort of sense of decency probably would. We're gonna just shift slight tack on this, just as we wrap up kind of this episode, because we got a ton of stuff we want to go through in the next session as well. But let's touch on not the state of venture now, but you and I think we know quite a lot of emerging managers. VC landscape has shifted quite dramatically. Recently we talked about it. Recent news is Harry Stebbings, who of course was one of the partners at Stride in Fund 1, has gone out and raised second fund of 400 million at 20 VC. But there's been like this seismic. I mean, Harry is almost the outlier in that sense, right? Like a lot of the stories I certainly hear from emerging managers at the moment is fundraising is really hard. Getting LPs to commit and stay committed is really hard. But also just the nature of venture has changed somewhat in the last couple of years as compared to, let's say, the last 6 years. May have actually reverted to what it was a decade ago or whatever. But so where do you see the landscape at the moment, and how do you see, I think I saw a metric yesterday, something like there was 62% fewer funds or fewer funds deploying this year versus last year or something in the US. Like, there's been a clear change. I mean, it's kind of a muddled up question, but I guess if you split it into two, where's the VC landscape sitting right now, and what does that mean for emerging managers maybe?
Yeah, so let's deal with the data point first. There was a Cambrian explosion in the number of VC funds. So it's interesting because we look at last year's data, 2 years ago data, and we say, oh, look, the market's crashing. But if you look back 7 years ago, people were saying there are way too many funds getting started and they're undifferentiated. And there were like 4,000 seed funds in the US or some insane number.
All backing exceptional founders.
Right.
And,
in future of work and future of learning or something.
And marketplaces and all that.
So everybody's got the same investment thesis and it's all self-same. And, I've got some angle because I'm in Philadelphia and I went to that uni or something. So look, way too many funds. And now we're looking at last year's data and saying, oh my God, the market's crashing. So if you can look through the most insane cycle we've lived through since 2000, I think probably you'll see that the venture industry is an expanding asset class. Second thing is, let 1,000 flowers bloom. I think there's everybody's always preaching for their own chapel, whatever their strategy is. So I'm a boutique craft person, right? You want to work with me because I'm actually a good board member. That's why you come to me. If I was a deep tech index investor and I had a very clear set of investment theses around tech bio or computational genomics or whatever it is, and I was able to find companies incredibly early and I would check super fast, and my value add would be, I find you, I write a check quickly, and I syndicate. Yeah. And I did nothing else for you. That's also a great investment strategy. I'm like, more power to you. If I'm Harry and I've built the most insane network in the world and I can parlay that network and those learnings into, a network asset that I can actually deliver on for founders, I'm like, more power to you. That also works. Because it's differentiated, because it's got a massive media outlet, and it's got one of the world's best networks.
Yeah.
I mean, his entire network probably outclasses most tier 1 VC firms.
For sure.
So, okay, so he's got something. The question is,
what do you have?
Why do you exist?
Yeah.
And why do you need to be here?
Yeah.
And, a lot of what I hear that passes for investment strategy is some kind of regurgitation of recent tech trends applied to a specific sector that people find interesting, and that's that, right? And so you go one level deeper and you realize there's not that much thinking. So LPs are going to hear 100 of these pitches, AI, sensors, like whatever version of that. And we're doing financial inclusion and health and mental health and a third topic, right? Sorry, but there's 150 similar pitches in market. So if you get Sam Cash, he went after industrial environments. It's very narrow. It's very clear. It's a good single GP positioning. He's raising fine because he has a reason to exist, and he organized a little conference around it that's got a good number of people going. So like, more power to you. Or if you look at Nucleus, Max at Nucleus, that's a pure synthetic biology fund, and with a good group of advisors, etc. And they're super vertical in that. So I know exactly what risk I'm buying as an LP. So this is not a time to be generic.
Right. The generalist VC, like the era of the generalist VC is.
I didn't say that.
Yeah. Oh, okay.
I said generic.
Generic. Yeah. Okay.
Generalist is a strategy that you can still sustain if you've got the tools to do it.
Yeah. But if you are just doing the same as ABC,
Excel's a generalist.
Yeah.
But good luck taking them off their position.
Yeah.
General Catalyst is a fascinating firm that continues to innovate. So I think there's a lot of innovation, data, blah, blah, blah. But, none of this is one size fits all. And I love the diversity that we've got. And then as an emerging manager, if you can't raise, then that's reality. And then the question is, do you want to go hit your head against the wall for 2 years, or do you want to readjust? And you can blame the LP market all you want. There is money out there. It's not easy to get, but I would argue or question whether how well we would have done without EIF, for example, versus with the EIF.
Yeah.
Because how many managers are in business because of the existence of private funds? And what would have happened if this wasn't there at all?
Yeah.
Would it have been harder to build VCs? Sure. Would you have had better teams potentially, more differentiated teams, etc.? I don't know.
It's that question of is the capital bringing the talent, or is the talent driving the capital?
Right. So it's like, you want to, there's a point where, okay, I'm seeding the ecosystem. That's one thing. But now I am the ecosystem. EIF is such a juggernaut. And you got to go like, well, okay, but what kind of ecosystem is that? How good is it?
Yeah, so that's a European investment fund. And then you have obviously the British Business Bank here in the UK, which, Cornerstone's up to 25 million, I think, in emerging funds. And yeah, it means that, and nothing is easy, right? But that access to that initial capital and that cornerstone potentially is there. It just means that more people can get involved. The question then, I guess, that arises is, what do those returns look like? But that you're only going to see in 10 years, right? And that's going to be the...
Yeah. I mean, it's, if you between EIS tax relief, EIS tax relief is too much of a skew.
Oh, yeah, for sure.
Right? It's kind of created a whole class of companies that are probably shouldn't be there.
But
people don't know what they're doing.
Yeah, so we had Josh Bell from Dawn Capital, and I asked him explicitly, and he said of the 70 odd investments or whatever, he said he doubts any of them would have had EIS, have raised under the EIS or SEIS in the past. And I think, because I see this a lot, right? I think like there is this weird dichotomy where founders raise under the SEIS and EIS schemes, which, are wonderful from the perspective of very early stage pre-seed capital. But because they can raise at SEIS or EIS, they assume that they are therefore on track to raise from venture. But actually, SEIS and EIS, tends to inflate valuations a little bit, right? So entry points for VCs then don't make sense necessarily. And B, they are different classes, right, of capital, right? So EIS and SEIS, yes, of course, there is an element of looking for outsized returns, but for a lot of investors investing under those schemes, it really is about the tax break, right? Like, so
correct. Yeah.
And I think this is the thing in the UK. We've therefore had this just like massive, blossoming of companies being built, which is great. But it's always this caution that building a company, raising on SEIS, EIS does not mean that you are suited for or should consider taking venture.
Yeah, I mean, if you want to look at this differently, when you go to San Francisco and you come with the stupidest idea in the world, people are going to go, that's great.
Yeah.
Fucking go for it.
Yeah.
When you look at EIS, SEIS investment groups, what do they sell to their members? We're really good about making sure the legals are tight. We're really good about due diligence, or some bullshit. So they're selling downside protection on a tax advantage investment.
Yeah, exactly. Yeah.
That's the mindset. And I'm like, what do you think's gonna happen? Right? So the problem is it's not risk capital.
Yeah, exactly.
It's a tax harbor for people who they kind of want to dabble or something. So the whole setup's kind of wrong, right? So where's the UK angel list? And the reason why we run Angel Unconference with Pietro at Firedrop and Stride every year.
I came because 2022, I think.
Yeah, we're trying to get 80, 100 angels together, so that community fosters, this, and so that we get better together at actually backing risk businesses from the beginning and not holding them back and allowing them to run fast and allowing them to fail and go like, fuck yeah, let's build.
And not worrying about whether you get a 50% or a 30% tax break as a result. Right?
Correct.
Yeah. So I think that feels like a good place to kind of pause for now, because we've got a whole nother episode where we're going to get into some pretty personal, I guess, level sort of discourse on where you are at and sort of philosophy, the philosophy of how you've gotten to where you are. For the time being, Fred, thank you so much for joining me here in studio. It's been incredible. I feel like we could talk about a lot of this stuff for a lot more, but let's now park that and talk about the future a bit.
Amazing. Thank you so much.